So in case study number 2, we looked at charitable contributions of C corporation stock. And you might think that it would be similar to give S corporation stock, but it's completely different, much, much more complicated. So this case study is going to go through a donor in the same situation, but as an S corporation shareholder, and different ways of being able to mitigate that tax. So to me, it was interesting that there are more S corporations in this country than C corporations and LLCs combined. So if somebody tells me I have a closely held or privately held business interest, the odds are very good that it's an S corporation. And to take a bit back in time, quick step back in time, in 1998, Congress passed a law that said that S corporations could be owned by charities without blowing the S election. Prior to that, it was impossible. But we kept reading as the charities. And it said that the charity has to take a carryover adjusted tax basis from the donor. We said, why does that matter? We're taking a carryover tax basis from the donor, we're tax exempt, who cares? The problem was that the charity has to take an adjusted carryover tax basis from the donor because any pre-contribution, post-contribution, and income during the holding period, all of those things, pre-contribution gain, post-contribution gain, income during the holding period, are all unrelated business taxable income. It is a hammer. What does that mean? That means if you had $1 million of stock, S corporation stock, and your cost basis is $100,000, and I contribute that to a public charity that's in corporate form. Most all charities are corporations. So if you give that $1 million of stock to, let's say, a university that is a corporation, and the cost basis was $100,000, you sold it, the charity sold it for $1 million 2 weeks later. As soon as that charity sells that $1 million of stock, it immediately must recognize $900,000 of income, all of the gain. And because it's unrelated business taxable income, for the purposes of that transaction, the charity is not a charity. It would be a Tennessee corporation. So now you're having to pay full corporate federal rates, and you're having to pay corporate state income tax rates. So the quick of that is $900,000 of gain, you might be paying 35–38% tax on all of that gain. When most advisors hear this, the immediate reaction, which is rational, is they would say, do not give S corporation stock to charities that are in corporate form, because the 35–38% tax rate is a whole lot more than the 20–25% tax rate for individual long-term capital gains. And my 25% was assuming a state income tax as well, so federal and state at 25%. There is a solution. So when you look at S corporation stock, as long as you understand what the tax regime will be, there is a way to actually take advantage of trust tax rates vis-a-vis corporate tax rates. So in this case study, what you'll see is the same $1 million of stock, the same $100,000 cost basis. But rather than giving that to a charity in corporate form, the charity that we're going to use for this case study, we helped set up about 7 years ago. There are a number of these that exist, but as a national donor advised fund in trust form, and it's situs in Nevada. No state income taxes in Nevada. So now, when the donor makes the contribution of $1 million in the shares, the donor can get a full fair market value deduction for those S corporation shares, so they get $1 million deduction. The trust, in this case, receives those shares and sells them. The same $900,000 of gain that the corporation would have, the $100,000 basis to the $1 million of shares, the same $900,000 of gain must be recognized at the trust level. But long-term capital gains are taxed at individual rates within trusts. So that's arbitrage number one. Instead of paying the 35 to 38% corporate income tax rate, now the trust is only having to pay a 20% capital gains rate. Second arbitrage, as I mentioned, it's in Nevada. So no state income taxes in Nevada. That's the second savings. And the third is because the trust is taxed as an individual, when it turns around as a donor-advised fund and makes the grant right back to, let's say, a community foundation or to the American College, the trust is taxed as an individual, so the trust itself gets a 50%, 50% charitable income tax deduction at the trust level. So what does all of this mean? $1 million share value can be donated to the charity and trust form. $1 million deduction taken by the donor. No estate tax, obviously, for any of that. It's out of the estate for estate tax purposes. When sold, all the capital gain that the otherwise donor would have to pay, the trust has to recognize, but at individual rates at 20% federal, no state, and because the trust itself gets a 50% adjusted gross income deduction, when it then makes the grant of all the proceeds over to the other public charity, that takes the 20% effective gains rate down to 10%. So 100% deduction, 10% toll on tax. Most of these charities do charge a donation or a fee of about 2 to 3%. So roughly 87 cents on the dollar ends up as a grant to the charities that the donor originally wanted to make the contribution to. So that is a UBIT mitigation solution for charitable donations of S Corporation stock.